Hi everyone, and welcome to Investing Strategies. It's Alissa Coram with Investors Business Daily from the NASDAQ market site in Times Square. Today we're analyzing the impact of further trade war escalation. With heightened volatility being the new norm, what trading tactics should investors deploy now? The Chief Investment Strategist at Tengler Wealth Management is here to discuss, and we'll zero in on two potential stocks for your watch list. And in a choppy environment, it can be difficult to find stocks that are actually outperforming. So I'll be walking you through IBD's tips for finding top stocks in volatile markets. Plus, the CEO of GraniteShares is here to talk about the recent rally in gold and why he thinks the safe haven asset deserves a spot in your portfolio. Investing Strategies starts now. All right, let's begin with our market insights this week. Joining me for today's discussion is Nancy Tengler. She's the Chief Investment Strategist at Tengler Wealth Management. Thanks so much for joining me today, Nancy.
Thank you, Alyssa. It's good to be
All
here.
right, so for the last month, we've seen a very volatile, range-bound, sideways market. What do you make of the action that we've seen lately, and is this what investors should expect to continue to see for the next month or so?
Yeah, good point. So first of all, we should note that it's been a great year. I mean, despite all the volatility and the exhausting tweets, the market's up mid double digits, solid performance, but it doesn't feel like it. In August, what we saw was, I think, some bad news about trade and a lack of attendance on Wall Street. And so because there's not a lot of liquidity, the market moved in exaggerated movements both ways. And I would expect to see that, even though most investors are back from the Hamptons, I would expect to see that continue as we try to sort out where, if anywhere, trade is going to go in the next couple of months.
Right, yeah, the unresolved trade issue, definitely the big overhang in the market here. And then it's also having an impact on other things like consumer confidence, right?
Yeah, and I don't think the president factored that into his equation. He keeps saying that consumers are not paying the tariffs, but they will be. Just look at the Apple Watch that got hit with the tariff starting on Sunday, and we'll see that in December if we don't get there sooner. That companies are not going to be able to pass along or keep from passing along these price hikes. And so though the president likes to say that the Chinese are paying, it really is going to be the American consumer as we move forward from here. And I think that's going to have a profoundly negative effect. We already saw it in the University of Michigan confidence numbers. I think that's going to continue as the turmoil continues. It's just unsettling.
Right, and then the impact on business spending as well. So, we're seeing it on the business front and the consumer front as well. So obviously there's a lot of different scenarios that could play out here, but what do you think is the most likely scenario?
Well, I think the president wants to get reelected. So at some point, I think we'll see some sort of resolution. But we just got the ISM manufacturing numbers. They were below expansionary for the first time in 3 years. So 50 is still expansionary. They dropped to 49 and change. That's on top of the market manufacturing numbers. These are important metrics for investors because what they tell you is that what we all know, CEO confidence is waning because they don't know what the rules of the game are, and so they're not investing. You need investment for productivity to improve and for corporate margins to continue to expand in the face of rising wages. So I actually take this fairly seriously. It may get revised up as the market did today, but we're still teetering on contractionary policies, and that combined with the consumer has got to get the attention of the White House.
Right, and so if we can expect more volatility, then how do you recommend investors position their portfolios during this time if we're not really making a lot of headway here?
Right. Well, so the defensive trade, like electric utilities, they were the top performing group through August, or through the end of August, but they were followed swiftly by software and semis. Semis tend to be a portend of future expansion, so the whole thing is a little goofy from the standard way we look at the market. But if you look at dividend-paying companies that are raising the dividend, the S&P is already trading above the 10-year and above the 30-year bond now. So we like to buy companies that are growing the dividend, not the highest payers in the universe, first, but the ones that are growing their dividends, because that's usually an indication of what management thinks about future earnings prospects. So we like a lot, it's not really so much driven by sectors, but by individual names.
Well, let's take a look at some of those individual names for our stocks to watch this week. So first up, let's talk about Microsoft. Obviously, it's had such a huge run this year. This is definitely a growth stock that we've been paying attention to. Of course, quite a laggard for many years, and within the last couple of years, really reinventing itself. So what is your outlook for this company, which is, you know, the biggest name in the market right now?
Yeah, I know, and it's sort of counterintuitive that I would be recommending it, because it is one of our largest holdings, and we are a relative value manager, which means we get to buy fallen angel growth stocks, and Microsoft is no longer a fallen angel, but when we acquired it, it was, and we're still buying it with new money. Here's why. They are pretty much hitting on all cylinders. It's a new and excellent management team. If you look at their cloud business, Azure, you'll see that not only are they growing at 60+% year over year, and that's come down from 90+%, but they're taking share from Amazon's AWS cloud business. And I think that is really the majority of the story. The margins are incredible. LinkedIn, software, and gaming, all are really sort of hitting on all cylinders, as I said. And on a valuation basis, it's still attractive, according to our work. It's not a screaming buy, but it's definitely a buy some and hold right here. And so I think there's plenty of room for this company to continue to expand and grow share price and the dividend.
All right. And I mean, as we know, software, that sector has just been huge this year. So it really looks like that is going to be a big part of the story for Microsoft moving forward, you think?
Yeah, and this is a space that companies have to spend on. So while they may be pulling back on other infrastructure spending, software hasn't really slowed down. And so we think the cloud, the importance of the cloud, the diversification of the business, and the nimble the agility of this management team is super important to future prospects.
Right, and software not quite as exposed to trade war tensions as other areas in tech might be?
Definitely. Microsoft is not something you're going to worry about if the trade tensions worsen from here.
So where exactly are you looking to buy this stock? IBD does have it forming a base pattern right now. We like looking at our charts, but where would you be looking to add here?
Well, so we look at a metric called relative price to sales ratio, and then we combine that with relative dividend yield. And it's not a buy on relative dividend yield, and it's just outside our buy range on relative price to sales ratio. So I'm not a technician. We don't try to get too tricky. We accumulate a little bit here. We accumulate a little bit more as we get new money from clients. It represents about 4.5% of our portfolios, but we continue to add to it with new money. And so I'm comfortable in here. I'm not comfortable at 150. Then we're pushing our ranges.
All right, well, let's take a look at another stock, and that is Broadcom. Now, Broadcom might be a little bit more exposed to the China trade tensions, but what do you see in this name?
Yeah, so counterintuitively, all the semis have done well, as I mentioned earlier. And so I don't know if there's a secret message in there that things will recover when we're not even in a recession yet, obviously, but it sounds like we are because everyone keeps talking about it.
Right.
So Broadcom's management team has been excellent at acquiring companies, rationalizing costs, and then growing. So about a year ago, they announced the acquisition of Computer Associates. Analysts were up in arms, mostly I think because it wasn't their idea, and the software side of the business didn't seem to fit with chips, but they completed the acquisition. It was accretive almost immediately, and then they announced the acquisition of Symantec. They ended up buying a portion of it in the security side, and that's good. I mean, all of that is good diversification. We like the management team. They've been growing the dividend about 50% per year over the last 5 years. I think that, and it's one of the cheapest in the group, so I think that the China worries are sort of reflected in the price. It's up about 37% from a year ago. It's one of those stealth movers. Nobody really talks about it. They don't really like it, but we've been acquiring it, and we would continue to add to it at these levels.
All right, so you think that semiconductors can continue to hold up relatively well, or does it depend on the rhetoric?
I think it's name by name.
Yeah, name by name.
So you want to be careful. I think valuation matters in in here, and so this is one of the cheapest in the group, and that's why we've been acquiring it.
And a management team that
has a great
seems
track
to be
record.
having a good
Yeah,
track record.
Hock Tan is consistently underestimated, and so every time he makes an acquisition, not every time, but most times, Wall Street, doesn't like the idea, and then they warm up to it shortly thereafter. So the stock sold off when he made the announcement about Computer Associates, and then as it settled in and it was clear he could execute, and there was some rationale behind it, the stock took off. And so, but even still, it's compellingly cheap from a relative dividend yield basis, from a price to earnings basis, if you look at that, and a relative price to sales basis. What are we paying for a future unit of sales? Not very much compared to most others in the space.
Right. Well, with shares consolidating, we'll have to see where it moves from here. Nancy,
Yep.
Thank you so much for all your insights
Thanks,
today.
Alyssa.
Really appreciate it. All right. And coming up after the break, I'm breaking down how to find top performing stocks amid volatile market conditions. We'll be right back.
Pick winning stocks with MarketSmith. Growth 250 shows you ideas with big potential. View charts packed with key data. Use pattern recognition to see action zones. MarketSmith by Investors Business Daily. Try 3 weeks for $19.95.
Now, between trade war and yield curve headlines, investors have been on a bumpy ride lately. And as tensions between the U.S. and China continue, there's no clear end to that volatility in sight. Now, the wild swings can make it pretty hard for investors to capture gains, but that's where IBD's tips for finding top stocks in volatile markets come in. Now, first, the vast majority of stocks move in the same direction as the overall market. So when the market is choppy with an uptrend under pressure, many stocks are going to have a difficult time advancing in a meaningful way. That's why it's not a good idea to aggressively make new buys unless the market is in a confirmed uptrend. So while you're waiting for a new rally, that doesn't mean you should stop paying attention to the market. Now, during a volatile market, top stocks are consolidating their gains and forming new base patterns. So the most important thing investors should do when the market is choppy is to look for stocks that are outperforming and put them on your watch list. Those stocks will likely be the first to blast higher once a new market rally begins. Now, a great way to determine outperformance is by using IBD's relative strength line. So let's take a look at a chart for Hexcel to explain. Now, the relative strength line on this chart is the blue line here, and it measures a stock's price performance versus the S&P 500. So when the line is moving higher, that means the stock is outperforming the S&P. And when the market is volatile, seeing a stock's relative strength line at a new high is very bullish. Now, this is a weekly chart here, and shares of the aerospace and defense stock are forming a flat base and moving towards a buy point at 85.73 here. That's 10 cents above the stock's prior high. And Hexcel's relative strength line is at a new high, even though the stock has yet to hit a new price high. Now, that's especially bullish action. This is definitely what a strong stock in a volatile market looks like. And if Hexcel's relative strength line can hit a new high in these conditions, as it forms a chart pattern, our research shows that this is the type of stock that will likely be among the first to break out into buy range once we see a new market uptrend. Okay, now let's take a look at another example, and that's Roku. The relative strength line for Roku has been on a tear. This is another weekly chart here. And in addition to using the relative strength line to find stocks for your watch list, you can also use the relative strength line as a confirming technical indicator when a stock is breaking out into buy range. Now, when Roku broke out of a base in May on earnings, that relative strength line was hitting a new high, and shares have since doubled. Now, Roku is a rare stock that's resisting the volatility right now, logging strong gains over the last month. And this recent rally was sparked by a quarterly report that showed accelerating revenue growth. And Roku is well above its moving averages. So for investors who bought the stock when it broke out in May, the stock is yet to trigger a sell signal. Long-term shareholders can use a close below this 10-week line here in heavy volume as their signal to sell, while shorter-term holders should keep an eye on the 10-day moving average. So as you can see, if you focus on buying stocks that are outperforming the market, those are likely going to hold up the best once volatility hits. Now, IBD's MarketSmith platform has a list of stocks with relative strength lines at new highs, and that list gets continually updated. So that's one easy way to find strong stocks for your watch list during a rough market. So remember, don't aggressively make new buys when the market is choppy. But even amid volatile conditions, make sure you're keeping an eye out for stocks that are holding strong. The benefit of a sideways market is the creation of these new chart patterns for many top stocks, meaning fresh buying opportunities once a new market uptrend begins. And when we come back, we'll be taking a look at the big move in gold over the past few months and why investors may want to consider this commodity amid rising global uncertainty. Don't go away.
On Cultural Capital, we are in New York City and San Francisco. Come with me as I tour some of the world's most innovative companies, from Squarespace to C3 AI, Giphy, and Figma. Learn how CEOs built growing companies while maintaining the ultimate office culture on Season 3 of Cultural Capital on the brand new NASDAQ.com.
With all the market volatility we've seen as of late, investors are flocking to gold. And here with me now to talk about the popular safe haven asset from an ETF perspective is Will Rind. He's the CEO of GraniteShares. Thanks for being here, Will.
Thank you. Good to have me.
All right, so gold has just been on a tear lately. Even before we saw all of the volatility that we saw in the last month, before that, gold was already rallying. What do you attribute to the strong move that it's made over the last few months?
Well, there are a number of things. I think probably the most important thing is interest rates are declining here in the US for the first time in a number of years, and actually across the world. And so when interest rates are falling, that makes the cost of holding gold lower and therefore more attractive to investors. And I think really that's the major driver at the moment.
Mm-hmm. And then in addition to what's going on with interest rates, all the global uncertainty that we're seeing making gold appealing as well?
Exactly. So I guess you have to ask the question, well, why are interest rates falling? And interest rates are falling primarily because the global economy is slowing down. And when we get a situation where the global economy is slowing down, people start to worry about all sorts of different sectors and factors, which breeds this uncertainty, which then gold responds to. And so gold, you can think of it as a kind of a read of the temperature of the market or of sentiment. And if you get uncertainty like we're seeing currently, the price of gold will most certainly rise.
Right, and with a lot of headlines that we've seen lately and still a lot of unresolved global issues, is your expectation then that gold will continue to move higher even though it's been up so much already?
Yeah, I think gold prices have come up, but put it into context, they're still some way away from the all-time high that we saw back in 2012. And so when you look at the all-time high price of just over $1,900 an ounce, where gold prices today are just a little bit over $1,500, is still some way away. Contrast that to what we see in the stock market and other asset markets around the world where markets are trading at or near all-time highs. So I think from a gold perspective, we're not quite there yet, and gold prices have moved up, but they've come from a low base.
Right. So GraniteShares, of course, has a gold ETF. So can you tell us a little bit about what investors are getting with that and why you think it would be something for them to look into to add to their portfolios?
Sure. So we have the GraniteShares Gold Trust. The ticker code is BAR or BAR. Which is probably a good, memorable name for a gold ETF.
Definitely.
And
all those fun ETF names.
Exactly. And so very simply, it allows you to track the gold price. And so putting gold in a portfolio. And that's really the main benefit that it provides investors. It's very low cost from a management fee perspective. So in some cases, it's over half the cost of some of the more well-known gold ETFs. So very cost effective when you're putting it in the portfolio. But further to that, I think it replicates the gold price very well. So it's looking to give you exposure to the gold price. So gold price moves up or down, it will track it accordingly. All the gold is held in London and is audited 2 times a year, once at random. A third-party firm that actually comes into the gold vault and looks at the gold bars. And we publish that bar list on our website, GraniteShares.com. So I think for anybody looking to invest in gold, they should check out BAR or GraniteShares Gold Trust. And I think from a perspective of holding gold for the long term, you want to own gold as low a cost as possible, and that's where BAR comes in.
Right, and then what are you seeing in terms of other precious metals out there? Are they making as big of a move as what we're seeing with gold, or what can you tell us about some of the other areas?
Yeah, I mean, certainly it's not just limited to gold. So gold is the biggest, asset class, if you will, in the precious metals or in the commodity world. So it gets the most attention. But there are other metals as well. And so platinum, for example, silver, palladium are other metals in the precious metals family that have also been getting a bit of press. And particularly silver, because it's probably the closest to gold in terms of its, once upon a time form of money, now a kind of quasi-currency, if you will. And I think what's interesting is that in this world where you have negative interest rates in a lot of the world, in terms of government bonds are now 18 trillion or so outstanding in terms of negative interest rates, you have an environment where people are looking for alternative forms of currency. And not that specifically gold or platinum or any are currency specifically, but they're hard assets which have some of these quasi-currency attributes. And I think in this kind of environment where governments around the world are looking to debase their currencies through monetary easing programs, people are looking to hard assets more as a way to hedge against that. And so we've seen the price of silver move up pretty significantly, palladium also, and then now most recently platinum. So people are looking at these other metals, I think, as a sort of quasi-currency alternative to some of the other paper currencies around the world.
Interesting. And then other alternative ways to gain income, investors also interested in, given the heightened market volatility that we're seeing when it comes to buying individual stocks, maybe not a lot of headway being made with the sideways market that we're seeing. So what are other ways that investors can get income in a sideways market today?
So certainly I think this is a huge, huge issue. And it was something I think that people felt perhaps mentally that we were returning to some kind of normalcy in terms of interest rate policy as interest rates were rising. But obviously since the beginning of this year and the Fed's sort of about turn in terms of interest rates, we're now seeing interest rates on the way down again. And indeed, there's more probability right now of rates going to zero than there is rates rising again. And so we're now in this incredibly difficult period for investors or for savers in particular who are looking for or need income as to where do you get it. You're looking at countries around the world that have negative interest rates on government bonds. The US now, even though we still have positive interest rates here, they're not as positive as they once were even 6 months ago. And so people are looking for income. We at GraniteShares have a solution for people looking for income. It's called HIPS, ticker code HIPS. Stands for High Income Pass-Through Securities. And the idea here is that nowadays I think you've got to go and look for income in different ways and non-traditional ways. And so everybody will be familiar with buying dividend-paying stocks or buying bonds for income. But what HIPS does is look at another different category called pass-through securities. And pass-through securities are entities that don't pay corporate tax. So those would be things like master limited partnerships or MLPs, or REITs, real estate investment trusts, or BDCs, business development companies. They all distribute a high level of income. So packaged together as a diversified fund, HIPS pays a income or yield, if you will, of somewhere around 7%. Now that's pretty high relative to, say, the 10-year government bond here in the US, or any kind of corporate bonds, or even dividend-paying stocks. And so I think when people are now looking for income, they're going to have to look for income in non-traditional sources. We call this alternative income, but they're still listed securities. It's still an ETF that anybody can buy and sell on the market, but HIPS or HIPS is a way that people can still achieve a high level of income in this very yield-depressed market.
Okay, so what in your view then is the benefit over a product like this when you're comparing it to, say, an index fund, or is that not really apples to apples there?
So that's much more broad market, so allows you to invest in what some people would sort of assume is the stock market at large, but the yield on the S&P is very small in comparison. So I think it's somewhere around 1.5%. For comparison versus something like HIPS, which is 7%. So gives you exposure to the broad stock market, but it's not something that people are going to get a lot of income from if they need that income for retirement or for any other purpose.
All right, well, thank you for breaking down this income play for us, as well as talking all about gold. We really appreciate it, Will.
Thank you so much.
All right, and thank you all for watching Investing Strategies. We'll see you right back here next week for our medical sector themed show. For Investors Business Daily, I'm Alissa Coram.